What do you think when you see Uber valued at $17 billion and WhatsApp bought for $19 billion and Snapchat worth somewhere above $10 billion? What do you think about the valuations?
Well, there is sort of always this recurrent question whether we have a bubble in technology like we had in the late 90s. I tend to think that there is no bubble in tech because these bubbles are psychosocial phenomena in which you get the entire public involved. And the public has largely been absent this time around. The IPOs are happening very, very late. There are far fewer of them than there were in the late 90s. And so you do not have the sort of public frenzy around technology that you had in 99, 2000. If I had to identify a bubble today, and we had a bubble in tech in the 90s, we had a housing finance one in the last decade. The obvious place where the bubble exists today is in government, and it's in government's printing money. It's in government bonds probably, which is what governments are sort of buying up with all the money they're printing. And so I think that the place that our bubble, and in some ways the interest rates that are set by the government touch everything, but the center of the bubble are probably things that are most like government bonds. It's government bonds, corporate bonds, maybe it's parts of the housing market that are very linked to fixed income, maybe it's parts of the equity market that behave like fixed income, so it's stocks that pay high dividends, or it's these sort of value stocks where you have very predictable cash flows. Whereas the tech stocks are primarily valued on growth, which is a very different variable. I personally have about 3/4 of my net worth tied up in illiquid tech stocks in Silicon Valley and elsewhere. And I actually think that it's one of the best places to hide from this massive government bubble that exists everywhere else. So I think there is a bubble. It's not in tech, it's in government, and I invest in tech in order to hide from the bubble in government.
What is the one that you wish you'd invested in that you missed?
Well, there always are many misses that one has, but I think sort of the misses that count as misses are ones where you spend some time talking to the company, you have a real conversation, you really think about it. So I missed out on the Series A round at YouTube. I missed out on the Series A round at Zynga. I had lots of conversations with Mark Pincus and known him for many years and was very close to doing it. But far bigger miss than those two was not doing the Series B round at Facebook. And I think it's sort of very instructive, sort of set of mistakes that happened. We'd done this. I was the seed investor, did the Series A round, August of 2004. It had sort of a post-money valuation of 5.6, 5.7 million. And Facebook was just growing very fast. Sort of 8 months later, they sort of got this financing round. The Washington Post was offering 50 million, and then Excel, venture fund Silicon Valley came in, much higher valuation at 85 million. It was 12 times the price per share of the first round, the middle of dilution, but so it was much higher valuation in just 8 months. And I had this conversation with Mark, and it was like, why don't you do this whole round? Kind of like you, and I said, well, it's like gone up so much, and it felt like we had really maximized the valuation. And part of the psychology was that on the inside, it didn't feel like things had changed that much. You had this horrible graffiti art on the wall of the office. There were it was still only 8 or 9 people. So every day that you went to the office, it actually felt like it was the same company you had been at the day before. It was true there were these charts where things were moving in a very happy northeasterly direction, but these were abstractions that people I think didn't fully get in a way, and so whenever you have these massive up rounds in companies led by smart investors, almost as a rule of thumb, they are undervalued. And I've done this back testing on this, where the steeper the up round, the greater the undervaluation. And it's because when these companies have momentum, people underestimate the momentum. They underestimate when things change. They underestimate how much things have changed. And it's not just true of the outside investors, it's also true of the people on the inside. I course corrected on this in the Series C round in Facebook, which was at 525 million pre, just 1 year later, and so it was like 5x again. And it was sort of this question: what had I done wrong? And I think it was like, okay, this makes no sense at all. This is a really crazy valuation, but I'm going to still invest because there's something about the momentum that people are missing, and that was actually a round that I'm very glad to have participated in.
How did it work out?
Well, Facebook is worth more than 550 million, which is the post money on that round today.